Hello everyone, my name is Kiet and today I will be presenting the answers for question 1, chapter 31. How would the following transactions affect US exports, imports and net export? 1A. When an American art professor spends the summer touring museums in Europe, he spends money buying foreign goods and services, so US exports are unchanged. Imports increase and net exports decrease. B. When students in Paris flock to see the latest movie from Hollywood, foreigners are buying a US goods, so US exports rise. Uh, Imports are unchanged and net exports increase. C. When your uncle buys a new Volvo, an American is buying a foreign good, so US exports are unchanged. Imports rise and net exports decline. D. When the student bookstore at Oxford University sells a pair of Levi's 501 jeans, foreigners are buying US goods, so US exports increase, imports are unchanged, and net exports increase. When a Canadian citizen shops in northern Vermont to avoid Canadian sales taxes, a foreigner is buying US goods, so US exports increase, imports are unchanged, and net exports increase. So that's the end of my answer. Thank you for listening.
Hi guys, my name is Wayne, and today I'm doing chapter 31, question number 2. Would each of the following transactions be included in net export or net capital outflow? Be sure to say whether it would represent an increase or decrease in that variable. An American buys a Sony TV. An American buys a share of Sony stock. The Sony Benson fund buys a bond from the US Treasury. A worker at the Sony plant in Japan buys some Georgia peaches from an American farmer. So my answer is an American buys a Sony TV. This is an example of US citizen buying a good produced in Japan. Sony is a Japanese company, therefore imports increase, export unchanged, export decrease. An American buys a share of Sony stock. This is an example of a US citizen buying a foreign asset. Sony is a Japanese company, therefore net capital outflow increase.
Hello everyone, I'm Ting Dang and I'm going to present to you chapter 31, question 2, continue the answers of Huang. So the question is, would each of the following transactions be included in the net exports or net capital outflow? Be sure to say whether it would represent an increase or a decrease in that variable. C. The Sony Pension Fund buys a bond from the US Treasury. So, the Sony Pension Fund buys a bond from the US Treasury. This is an example of foreign company buying an US US Treasury bond. Therefore, net capital outflows decreases. In other words, this transactions count as a negative inflow. D. A worker at a Sony plant in Japan buys some Georgia peaches from an American farmer. This is an example of a foreign citizen's worker at Sony plant buying an American good. Therefore, US exports increases, imports change, and net exports increases. Thank you for listening.
Question 3, Chapter 31 describes the difference between the foreign direct investment and foreign portfolio investment. Corporations are an individual investor who is likely to engage in foreign portfolio investment. Indirect investment control follow the investment, whereas in portfolio investment control does not follow investment. The key difference between the foreign direct investment and foreign portfolio investment is how involved the investor is. The foreign direct investment requires actively managing an investment, for example, by opening a retail store in a foreign country. Foreign portfolio investment is passive, for example, buying a corporate stock in a retail chain in a foreign country. A corporation is likely to engage in foreign direct investment because they will probably have enough money to expand. An individual is likely to engage in foreign portfolio investment because the environment is simply better for them. The risk of foreign portfolio investment for an individual is less risky than expanding or creating their companies to a different country.
Hello, my name is Như and today I'm gonna answer the question number 1. Japan generally runs a significant trade surplus. Do you think this is more related to high foreign demand for Japanese goods, low Japanese demand for foreign goods, a high Japanese investment, or structural barriers against imports into Japan? And explain your answer. Japan generally runs a trade surplus because the Japanese saving rate is high relative to Japanese domestic investment, and the result is high net capital outflow, which is matched by high net exports, resulting in a trade surplus. The other possibilities, high foreign demand for Japanese goods, low Japanese demand for foreign goods, and structural barriers against imports into Japan could affect the real exchange rate, but not the trade surplus.
For question 2 of chapter 32, my answer is for A. In my opinion, if the Congress somehow passes an investment tax credit, this will subsidize the domestic investment, which is beneficial for firms that want to expand or grow more. So they will put more money, they will borrow more assets, which will result in an increase in loanable funds. The high interest rate also rises, while the net capital outflow decreases because units or companies are now focused more on domestic investment. Due to the strengthening in the domestic field, the storing of dollar on foreign fields will decline, or the supply of dollars, which will cause the real exchange rate to increase, so that the trade balance also decreases because exports are inferior now. B. Since the increasing of the exchange rate, the competition in exporting is become more harshly because this will reduce export. This will be hard for several large exporters in foreign market to compete with each other. So this will reduce the net export.